Hi, everyone. Thank you so much for joining us today. We are so excited to have you for the first webinar in our series for a successful sales tax strategy. Today is the first pillar. These go all the way to 8 pillars. So we're going to be doing one of these every single week into October. And please follow along with us. We hope you can make it to many of these, if not all of them. And before we get started, let's go over some housekeeping items. So first and foremost, if you are here for CPE credit, we do need you to do a couple things in order to receive that CPE credit. We will need you to answer our poll questions as they pop up on your screen. If you have any issues with that, please reach out and let me know. And you will also have to fill out the survey at the end of this webinar. You have to do both things in order to receive CPE credit. But yes, again, if you have any issues, please reach out and let me know. Another important thing to note here is if you have questions as we are going along, please reach out and ask those questions. You can wiggle your mouse around, and in the center of your screen, you should see Q&A button. Use that Q&A button and send us questions at any time. We're going to do our best to address them at the end of this webinar or follow up with you via email. So again, ask your questions as you have them. We're excited to answer them. We also will be sending out today's slides. Once we get the ball rolling, there will be a link in the chat. They're also already uploaded to Zoom and will be emailed to you in 24 hours. So keep your eye out for those slides. And again, if you have any trouble, just let me know. And a couple other housekeeping items here. I guess, we're getting back in the swing of these webinars, but I'm still getting up to speed here a little bit. So thanks for your patience. So another important thing here, we do have these webinars pre-recorded and available in the Salt Vault. You can access those at any time. The Salt Vault also has a lot of educational resources and is a really great value. So you can see some of the stuff is listed here. There's even more on our website. If you have questions about that, let me know as well. And some quick introductions. Quick introduction for Sales Tax and More. Sales Tax and More is a full service consulting and solutions firm. We have a really great team here of experienced tax professionals who are very dedicated to fulfilling your state tax and related needs. So we do a lot of sales tax returns, sales tax registrations, consultations, research, audit defense, exemption certificate management, and like our name states, more. So if you have questions about our services, please reach out and let us know. We would love to hear from you and we would love to work with you. And a quick introduction for our founder, Michael Fleming. Mike's state tax knowledge is very well-rounded and he has helped thousands of companies of all sizes and in all industries and is especially well known for his work in the e-commerce industry. And Mike, if you want to take it from here, let's get started.
Okay. Great introduction. You're not rusty at all, Ellie. Thank you very much. And welcome, everyone. Thank you for joining us today. We've got a lot of information we're going to cover. As Ellie said, this is the first pillar. It's all about Nexus. And we're going to talk about economic Nexus. We're going to talk about physical presence Nexus. And when we're talking about a physical presence Nexus, some of the activities are going to be obvious. Some are going to be less obvious. Some are going to be very common. When we say common, most, if not all states, look at the activity the same way. And then there's a whole bunch of activities that are state specific. So we'll give you some examples of those. We're going to go over some case studies, some important U.S. Supreme Court cases. We're going to dispel some myths and then answer some of your questions. So a lot of information today. And as always, the worst time for you to find out that either you have problems or that your clients have problems is when you're being contacted by the state. If you're getting a notice saying you're being audited, if you're getting a Nexus questionnaire, it can come by snail mail, it can come by email, you could get a telephone call, heck, you could even get someone knocking on your door. And the reason why that's the worst time to find out you have problems is because there are mitigation programs out there that if you're aware of these issues, you can be proactive and you can lessen some of that past liability. Programs like voluntary disclosure agreements and amnesties, just to name two. So the worst time to find out you have a problem is when you're being contacted by a state. And once the state contacts you, a lot of these mitigation programs are off the table. So that's why, we need to be proactive when we're, trying to figure out our own Nexus footprint or that for our clients. And Ellie, why don't we go to the first poll question?
That should be up on everyone's screen right now. We want to know, how would you rate your Nexus knowledge? Your choices are, what's Nexus? Nexus, you know the basics, you have an intermediary knowledge, or you are an expert. And Mike, it looks like we've got a good mix today, some absolute beginners, some people who fall in the middle, no experts out there. Why don't we close this and move forward?
All right. For those beginners out there, let's start with a real simple definition. And when we're talking about Nexus, it's just a fancy word. It means link or connection. And when it comes to taxes, it's the link or connection that must be present with the state before the state can require you to do anything. For example, before a state can make you collect its sales tax or vendor's use tax or pay its taxes like an income tax, a franchise tax, or a consumer's use tax, you have to have some sort of link or connection with that state. And we call that link or connection nexus. So taxability, totally different concept. A lot of people get the two confused. Nexus just means that you have some sort of link or connection with the state. And if you have this link or connection, you may have to get registered, not all the time. If what you're selling is not taxable, that's a whole nother issue. But it just means you may have a responsibility to collect and file or pay taxes in a state, which is why we say it all starts with Nexus. Because if you don't have this link or connection, if you don't have any nexus with the state cannot require you to do anything. So no link, no nexus equals no problems and no responsibility. Problem is, a lot of companies and sometimes their advisors, they don't know that they have this link or connection. And sometimes they know, but for whatever reason, they do not take any action. So that's where the crux of this issue is. And we're going to get into this a little bit deeper. But in all my years of doing this, every once in a while, someone has a huge assessment because of taxability. But most of the major liability that I see out there has to do with Nexus. So let's go to a couple court cases. And this is not going to be a deep dive. We're just going to touch on a few that I think are important to Nexus. This first one, National Geographic versus Board of Equalization. And by the way, these are all U.S. Supreme Court cases. This was a 1977 case. And the takeaway from this is that the taxable activity does not have to relate to the Nexus creating activity. Put simply, what that really means is once a company has Nexus, it has Nexus for all business channels. And this is becoming more important, especially since the pandemic. A lot of companies saw how well online companies did. And if you were a distributor or a wholesaler, you were selling, only to brick and mortar locations, your business took a hit just like theirs did, where the online companies, companies going directly to the consumer, did a whole lot better. So you're seeing a lot of traditional wholesalers and distributors all of a sudden start selling online and going direct to the consumer. The reason why that's a problem is that many of these people, they've been in business 30 years or so, and they have connections, links all across the country for their wholesale business. And they're thinking to themselves, okay, and they didn't really worry about it because they didn't have taxable sales. Now they're going to have taxable sales. And they start thinking, all right, when I cross a threshold, I'm going to get registered. Well, they forget that this wholesale business has created many of these links or connections. They may have independent sales reps. They may have salespeople. They may have independent contractors all across the country. So that's what this case is about. If you, the nexus for the wholesale channel is creating nexus for the retail channel, this online direct to the consumer channel. And rather than wait until they hit $500,000 in the state of Texas They should have been collecting from day number one. And if they wait and the state finds them, they all of a sudden they say, well, we're underneath the 500,000. They said, yeah, but you've got a salesperson in the state. Then $500,000 is a little bit of exposure there. So the next case I want to talk about is complete auto transit. And I like talking about this is because a lot of companies, individuals, a lot of FBA sellers in particular, they don't believe that states have the right to tax interstate commerce. And if we go back to the 30s, when the first modern day sales taxes came about, they were right. Even the states back then didn't think that they could tax interstate commerce directly. But that started to change in the 50s. And this case is a 1977 case. And the US Supreme Court really didn't come up anything new. They just cobbled together all of these decisions that they had had starting in the 50s. And they said, yes, a state can tax interstate commerce as long as it meets a four-pronged test. And it's a pretty easy four-pronged test to meet. I think that Illinois has gotten themselves in the implementation of their economic nexus. I think that even though this is a pretty easy test to meet, I think that they have run afoul of it. So we'll talk about that a little bit more. Next case I want to talk about is Scripto v. Carson and Tyler Pipe. Scripto is a Florida company. Is a Georgia company. Carson is Florida. And these are perhaps two of the most important cases out there when it comes to Nexus. And in all my years of doing this, I've already mentioned Nexus, it creates the biggest issues. This creates the biggest issue within Nexus because it just doesn't make common sense. So in Scripto, you had 10 independent contractors. They were making sales in the state of Florida. And Florida comes back and says, hey, we think these 10 independent contractors create enough of a significant nexus, a significant presence, that you should be collecting and paying our taxes. And Scripto said, you're out of your mind. These people are independent contractors, true arm's length transactions. We don't set their hours. We don't have anything to do with them. And unfortunately, the state sided with Florida. The court sided with the state, which was Florida. And the takeaway here is they said the difference between an employee and an independent contractor is without constitutional significance. In other words, it doesn't matter what you call them. They're doing the same job. This is revisited in 1987. You have Tyler Pipe. It's a Texas company. The state of Washington comes after them, and they said that they told Tyler Pipe, according to Scripto, we think you should be paying our business and occupation tax. And Tyler Pipe said, oh, this is not like Scripto at all. This is, someone, they don't even represent us exclusively. They're not very good at their job. We hardly get any business whatsoever. It's like having a part-time person. And unfortunately, this court again sides with the state. And very important language came out of this case. So I'm going to paraphrase in the beginning, but the second part is extremely important. We'll go into why it's so important also. So it doesn't matter what you call someone. Doesn't matter if they represent you exclusively or if they represent multiple parties. Doesn't matter how you pay them. Doesn't matter if you do this on a full-time or a part-time basis. Here's what matters. Are they helping you to establish or maintain a market? If they're helping you to establish or maintain a market, then that can be a nexus creating event. And this is the beginning of what we call attributional nexus or agency nexus. I try to keep it simple. I just call it third-party nexus. And the reason why this is so important is because so many of the states took this language, this establish or maintain a market, and incorporated it directly into their statutes, their rules, their guidelines. They use it to provide guidance to state courts. What better case to cite as precedent than a Supreme Court case? So very, very important. And the reason why this creates so many problems for so many people. It's the biggest issue that I've ever come across, biggest single issue, is because it just doesn't make common sense. If we're thinking about our activities and how we create links and connections with the state, we don't think of how third parties can create this link or connection for us. So a lot of smart people out there, including advisors to these companies out there, often miss this one. We're going to go into this a little bit deeper later on, but if you get nothing else today, this is the one point I want everyone to remember. Third parties, independent contractors, it doesn't matter what you call them, can create this link or connection that we call Nexus. And then perhaps one of the reasons why we're all here is the South Dakota versus Wayfair. This is the case that overturned the Quill Corp versus North Dakota and overturned National Bellis Hess. These were the two previous cases that talked about physical presence. And what is unique about this case, or at the time it was unique, very rarely does the Supreme Court come out and say, we were wrong. They didn't come out and say, hey, times have changed, so we need to change. They said we were wrong. We never should have introduced the concept of physical presence to begin with. We unintentionally created a protective class, and that's not what we should have done. So we're overturning this. And by overturning it, they were afraid, it's like these cases never happened. So in theory, the states could have went back to, 1967. And that was something that the court was fearful of. So South Dakota was pretty smart. And they said, we're only going to do this on a prospective basis. We're only going to do it going forward. And this ushered in economic nexus. It gave the Supreme Court enough cover for them to say, okay, South Dakota, you can move forward with this. Now, an economic nexus just means that this link or connection does not have to have a physical component to it. It can be based solely on sales or transactions or sales and transactions. South Dakota thought $100,000 or 200 transactions was fair. Now, the court gave them a wink and a nod, but they didn't come out and approve this per se. They sent it back to the lower court, and the case was decided before this matter was settled. So there still could be a little bit of question out there, and that's why you're going to see a lot of states moving away from the transactions. We'll talk about that. But a lot of states still have a transaction threshold. All states that have a sales tax now have thresholds. And Missouri became effective on January 1st of 2023. So even Missouri is getting a little bit old now. It's going to be coming up on 2 years shortly here. So a couple of points about this. Number one, this is not an internet issue. It's a multi-state issue. And our salespeople come to me with stories every day. Hey, Mike, I was talking to this accountant and he told me that he doesn't have any clients that are subject to this internet tax. Well, number one, as I mentioned earlier, tax and Nexus, two entirely different concepts. I said this on the phone the other day to a gentleman. We were having a consultation. I had to have said that 10 times, and he kept referring to this as the internet tax. Two totally different concepts. A tax is, that's going to have a rate, and you're going to collect a tax if something's taxable. This just means you may have a responsibility. You've got a link or connection with the state that maybe you have to worry about a tax. So this is not an internet tax, number one. But number two, it's not even an internet issue. You can be selling entirely by phone. You can be selling entirely by referral. You can be sending people into the state. You can be selling by infomercial. You can be selling by catalog. You don't even have to have a website. And this can impact you. If you're selling into multiple states, this probably could be an issue for you and or your clients. Second thing is, this does not override any other type of nexus. Here we are, this came into being in June of 2018. We just passed the 6-year anniversary. I still have people calling me, and some very smart people. And they say, Mike, I need to deregister in let's pick Texas or California. Both states have thresholds of $500,000. And neither state has a transaction threshold. So when I ask someone, or when our salesperson asks someone, well, why do you want to get deregistered? And they say, well, I'm underneath the $500,000 threshold and there are no transactions. So I want to deregister. And I'll ask a question, if they're in California, maybe I'll say, the last time we spoke, you had inventory in an Amazon warehouse. Oh, yeah, I still have that, but I'm underneath the $500,000 threshold. Or in Texas, last time we spoke, you had an independent contractor traveling into the state a couple of times a year. Oh, yeah, I still have that, but I want to deregister because I'm underneath the threshold. And at that point, I have to break it to them. It doesn't work that way. A physical presence, which, independent contractors and inventory are physical presence, the physical presence is going to override, it's going to trump an economic nexus when it comes to sales tax almost every time. When it comes to income tax, not so much. But when it comes to sales tax, that physical presence is going to trump the economic nexus. So the economic nexus doesn't protect you. It does not override any other type of nexus. It's just one more way for the states to get you to do what they want you to do, which is collect and remit their taxes. So as I mentioned, South Dakota said they were going to do this prospectively. In other words, only going forward. But it's going forward from their effective date. And that was 6 years ago. When this first started, nobody had any past exposure for economic nexus. Now, some people have 6 years worth of exposure because there's a couple of surveys out there, and 1 out of 2 companies is not compliant. I saw another one that actually said 60%. Now, those surveys are getting a little bit old, but our own internal experience tells us that those numbers are still running about true. And the states know that. So they're getting more aggressive, but I'm getting ahead of myself here. The effective dates are getting old. We've mentioned that a lot of the mitigation programs out there are not good, or that you can't use them if the state contacts you. So you don't want to procrastinate because your exposure is continuing to build. You've got states like South Dakota and South Carolina questioning registrations, the dates that you use to register. And you have states like Arkansas, Arizona, Illinois, Maine, and Wisconsin. They're actually auditing registrants. They're letting you get registered, and then a year down the road, or 2 years down the road, they're getting around to you and saying, hey, we think that you probably had Nexus prior to the date that you registered. And now you got to go back and pay all those taxes. In some states like Illinois, when they're doing this, if you're selling on Amazon, Amazon was not collecting in Illinois for some of that period. There was no marketplace facilitator there. So not only are you paying the taxes on your non-marketplace sales, you're also having to pay them on your marketplace sales. And they don't care how long it was. We had one client registered in January of 2019. The state came back. He should have registered in October of 2018. So we're really talking about 3 months here. And the state wanted all of their back tax plus the penalty and interest for that period. So it doesn't matter how long you've been compliant. These states that are aggressive and every couple of months, another state becomes aggressive and starts going back and checking these dates because they realize a lot of people just registered prospectively. So Arkansas and Arizona are fairly new to the list. Illinois and Wisconsin, they've been doing it for quite a while now. You have other states sending nice guy notices, Alabama and Kentucky. And some of these other states, like in Arizona, will send a nice guy notice. A nice guy notice is when you get a letter or an email and it's saying, we think that you need to check your dates. There's no threats or anything else. You just need to check your date. And if you use the wrong date, then you got to go out and you got to change the date and make sure you get caught up. They get more aggressive after that. They don't go away. You shouldn't really ignore these letters because the state's less likely to cooperate with you the more aggressive they have to be. Florida, Utah, they actually purchased lists that have a ranking of people who they believe actually crossed their thresholds. So nobody had any exposure back in 2018, but there's a heck of a lot of exposure out there now. So the reasons we hear why some people are waiting is they thought the Supreme Court was going to step back in. Well, the states, with the exception of Illinois, have implemented this fairly well. I don't think you're going to see the Supreme Court step back in. There may be some minor tweaks on this, but economic nexus is here to stay, unfortunately. So I don't know what people are waiting for. There's another group of people out there that just are unaware of it. They don't pay a lot of attention to sales tax. And this goes to not only companies, but it goes to some of their advisors. I speak to a lot of CPA groups out there, and I still find it hard to believe in this day and age that there are some people who aren't aware that they have clients that this will impact. Then another reason is everyone thought Congress was going to step in and solve this issue. And I'll give you an example from income tax. 1959 case, which resulted, it's Northwestern Cement, resulted in Public Law 86-272. That's a law that Congress passed. And when they passed it, this is about income tax nexus, but when they passed this law, they said this is a temporary law. And we have to do studies and empower commissions and panels. And, we really got to be able to get our arms around this. This is a complex issue here. That was in 1959. So that was what, 46 years ago or so? 45 years ago. And we still have this antiquated, federal law that, back then it only protected certain companies, and now it protects very few companies. So if we're waiting for an answer from Congress, maybe our great-great-grandchildren might get something, but I don't think that they're going to help anytime soon. I mean, heck, Congress can't even, agree on what to have for lunch, let alone any substantive issues here. So don't procrastinate. This is only something that's building with time, and it doesn't go away. All right, so we talked about there being a trend away from transactions, and the states up top is a list of states that originally had transactions, and they have done away with those transactions. So the state of Wyoming should be up there also. Ellie, we need to update this slide. But all of those states at one point had transaction thresholds, and they did away with them. The second group of states never had any transaction thresholds. And the third group of states don't have any standalone transactions. In the states that still have transaction thresholds, and about 35% of the states do. So we can't ignore transaction thresholds. Whenever I say there's a trend away, everyone says, oh, great, we don't have to worry anymore. And that's not what I'm saying. It's a positive momentum. A lot of states, including South Dakota, they're the ones that ushered in economic nexus. They did away with their 200 transaction threshold. But states like Illinois, states like New Jersey, they still have these transaction thresholds, and not just New Jersey just for sales tax, but for income tax. So it's still a big deal. In some states, about 35, 40% of the states still have transaction thresholds. Now, when there is a transaction threshold, the language the state uses is $100,000 or 200 transactions. The reason why Connecticut and New York are different is because they use the word and. So Connecticut says $100,000 and 200 transactions, whereas New York says $500,000 and 100 transactions. So those two states are different from the other states with transaction thresholds. Now, most of the states, came out with their guidance, fairly early on, close to 2018, 2019. There were some laggards in 2020. These are some of the changes since they initially came out. So Wyoming, they dropped their transaction threshold on July 1st. Indiana dropped theirs on January 1st of this year. They actually dropped it after that, but they retroactively made it effective back to January 1st. Louisiana dropped it in August of last year. South Dakota dropped it in July of last year. So this is the trend, and it's a very positive trend, but we can't ignore it, transaction thresholds at all now. When it comes to monetary thresholds, Arizona dropped their threshold to $100,000 on 1/1 of 2021. They started at $200,000, then they stepped it down to 150, and now it's at 100,000. That was all planned. Whereas Tennessee, during the pandemic, they thought their revenues were going to shrink dramatically. They didn't realize the federal government was going to give the states a boatload of money, and they didn't get hurt as bad as they thought. But when they thought they were going to see business dry up, they dropped the threshold from $500,000 to $100,000 because they wanted to capture more people. Now, the last three holdout states, and back in 2021, they pretty much all passed these laws, was Florida. Florida imposed a $100,000 threshold. There's no transactions. Became effective on July 1st of 2021. We're going to talk more about the look-back period. There's basically three ways states do look-back periods. One is the prior calendar year. Another is prior calendar year or current calendar year. And the third way is a rolling 12-month period. So Florida said, we're only going to look at the previous calendar year. So you looked all the way back to January 1st of 2020. And if you crossed $100,000 in 2020, then starting July 1st of 2021, you needed to start collecting the tax. Nowadays, every December, every January, you need to look at your sales in Florida. And if you're over $100,000, you should think about getting registered. If not, you wait until the following December. Pretty easy. You just got to check it once a year. Kansas, on the other hand, became effective on the same day. Again, $100,000, no transactions. But their look-back period is the previous calendar year or the current calendar year. And that's important if you've got rapid growth. I'll give you an example. There was one company that it was the month of March, so they just sent us their previous year's data. And I looked at that. They were a small company. We're actually doing their sales tax returns too. And I told them they had to register in another 2 or 3 states. So that would have put them at like 6 states total. And the salesperson came back and said, "No, Mike, they were on Shark Tank and their sales have exploded. You need to look at year-to-date information." So I said, "Okay, give me year-to-date information." And I looked at the year-to-date information, even though this was the month of March, it was towards the end of March. That number went from 2 or 3 states additional to another 16, 17 states additional where they needed to register. So if your business the growth is exploding and it's a state that has previous calendar year or current calendar year, you got to check it at least once a quarter if it's growing that quickly. If it's, growing the same pace that it did last year, then maybe you don't have to check it again till the end of the year anyway. You weren't over it last year. You may not be over it this year. So Depends on how quick you're going as to how many times you want to check it. Missouri, $100,000, no transactions. Missouri had a lot of problems with their local jurisdictions, so it didn't become effective until January 1st of 2023. Now, before I go to the next slide, I want to talk about the third way, this rolling 12-month period. Illinois is a great example of that. And what Illinois says is every quarter you need to check this. And if you have passed the $100,000 or 200 transaction threshold, then you need to get registered. So those are the ways that states look back. It's either previous calendar year plus the current calendar year, or rolling 12 months. All right. Many people still believe Alaska is one of the nomad states. Nomad, those are the states that don't have sales taxes. So it's New Hampshire, Oregon, Montana, Alaska, and Delaware. Those are the 5 nomad states. But we put out an article a couple of years ago now, Nomad No More, because all of these states have some sort of tax that looks or feels like a sales or a use tax. I mean, even Delaware, they have a tax on rental properties, tangible properties. So if you're renting into the state of Delaware, then you've got Nexus because you own something tangible there and you should be collecting the tax. Well, Alaska has local taxes. It's one of the home rule states. So a lot of the boroughs and a lot of the municipalities in Alaska actually have taxes. So Alaska formed what was called the Alaska Municipal League. These were all these local jurisdictions got together. Not all local jurisdictions are a part of this, but the majority of them are. And this Alaska Municipal League administers the taxes. So if you're over $100,000 or 200 transactions in the state, then you should be collecting and remitting tax in Alaska. Alabama, Arizona, Colorado, and Louisiana, these are the other states. These states may have problems with the Supreme Court at some point down the road, because the local jurisdictions say, if you have Nexus in the state, then you have Nexus with us. And, maybe you have one sale in a local jurisdiction and you've got to worry about collecting and remitting tax in that local jurisdiction. So the states themselves have tried to make it easier. Some states do a better job than others. Some states do a great job and then undo it for some reason. But those 4 states are some of the bigger problem states right now because of these local jurisdictions. Alabama, they say that if you only have an economic nexus, then you can just pay us the state and we'll distribute the money out to the local jurisdictions. So it's their remote seller program. So some, like I said, are making it easier than others. Now, here's one of the handouts that Ellie's going to get you today. This is also up on our website. We keep it updated. Every time a state makes a change, we update this. And every platform out there, every software company says, oh, we can figure out your economic nexus or your nexus in general. And I have yet to see any software that does a great job at determining where you should or should not register. One of the reasons is because it doesn't always have all of the data. We don't, run all of it through one site sometimes. For example, Shopify. And another reason why this isn't good is because no one gets granular enough. For example, what states say to include, right in that middle column there, or exclude from the remote seller threshold calculation. So some states include sales through a marketplace, which are your Amazon sales. Some states exclude them. Some states include sales for resale. Some states exclude them. Some states include exempt sales. So each state is going to be different. And all that a site like Shopify is looking at is your gross sales. So we have people come to us a lot of times and say, I want to get registered in these 20 states. Okay, how come? Well, Shopify told me to. Well, have you looked at through the numbers? Have you see if your fact pattern actually fits the requirements to be registered in each one of these states? And more often than not, instead of getting registered in 20 some odd states, we're recommending they get registered in 5 states, because when you back out these other sales, they just have not crossed the thresholds. And it happens in reverse a lot less often, because, maybe it's Avalara that you're using, and they're looking at all your sales, but they're not looking at your marketplace sales. So in states that include marketplace sales, they're not capturing those. So they're saying, oh, you're not over the thresholds, whereas if you included your Amazon sales, you would be over the thresholds. So software and platforms like Shopify, they have great tools. They're red flags. They should keep in front of mind that Nexus is not static, that you may have to get registered in additional states as time goes on and your activities change and your sales and transactions change. But before you run out based on software and get yourself registered, what you want to do is use a chart like this. So this is up on the website for free, and see if your specific fact pattern actually fits what the state is looking for. Save yourself a lot of headaches by doing something like this. Needless registrations. The other thing this chart is good for is it tells you when the effective dates were. Because if you got to figure out what your past exposure is, it's kind of hard to sometimes search each one of these states and figure out when their economic nexus became effective. What were the rules when it became effective? When did the rules change? All of that's on this chart. And a lot of useful information here. When is sales tax registration required after a threshold is passed? Some states, very next sale. Some states, 60 days. So states never make anything easy. It would be too easy to have all the same rules across the board. So we think that this chart is an invaluable tool, rather than just following the software. If you don't want to read the chart, we also have a cheap service out there. We believe it's cheap, that will do it for you. We'll make look at your data, last year, year to date. We will make recommendations on not only where you should register, but how you should register, whether it's a historical registration, a prospective registration, whether it's a VDA. And a lot of times we'll come back and say, do nothing, because you haven't crossed the threshold or your taxable sales are not material. So great chart. Ellie, why don't we go to the next polling question?
Yeah, absolutely. This is only the second polling question. If I know a couple people were wondering if they had missed any. Just a little bit of a quiz. Choose the best definition of nexus. Your choices are a linker connection with a state that must be present before a state can require you to collect its tax, working as a state employee and having to pay state income tax, a linker connection with a company and paying them taxes, working as an employee and filling out sales tax returns. And a quick reminder, you do have to answer the poll questions in order to receive the CPE credit. If you are having trouble viewing this poll question right now, please send me a message and I will help you sort that out. And Mike, why don't we leave this open and we can move forward, and I'll close it in a few seconds.
Okay, and the correct answer is a linker connection with a state that must be present. That is the correct answer on this one. And I apologize if you hear me sniffling here. My allergies are really killing me today. I live out in East Texas, a lot of big cedar trees here, and we had a big rainstorm yesterday, and you'd think it would wash it out of the air, but I'm suffering. So I apologize if you hear me sniffling here. Okay, so myth number one, I don't have to worry about sales tax nexus if I'm under the economic nexus thresholds. And, I gave you some examples of people calling up and saying, hey, I'm underneath the economic nexus threshold. I don't need to be registered. Well, physical presence is going to trump the economic nexus. So if you have any type of physical presence, you still need to be registered for Nexus. So that's a myth that you don't have to worry about sales tax if you're underneath the threshold. All right, which brings us to physical presence. And we mentioned that there are obvious physical presence, there are less obvious, and then there are common, and then there are state specific. So when we're talking about real property, whether you own it, whether you rent it, whether it's an office, a warehouse, a factory, I think we can all agree that this creates a link or a connection with a state. And it's very, very common. It's obvious and very common. So pretty much all states out there are going to consider these to be nexus creating activities. Now, one that's not so obvious is the virtual office. A lot of times I'll be talking to someone, they'll say, well, Mike, I don't have this link or connection that you talk about anywhere. Everything I do is in the cloud. Well, unfortunately, the states don't look at it that way. You are actually the link or connection where you live or operate your business from. And this is a very common nexus creating activity. Although it's not so obvious, it's still very common. And employees, and this is a big problem after the pandemic because employees can create this link or connection, even remote employees. And some states look at what the remote employee does, but by and large, if you have a remote employee in a state, the state's going to look at that as nexus creating. And this is a very common nexus creating activity. Now, one of the reasons why this is an issue is that during the pandemic, everyone was pretty much forced to work from home. And the state suspended these rules during that time period. But the pandemic is, for the most part, long past. And the states are enforcing these rules now. So this one, it's a little bit blurred. Was obvious, not obvious, where are we now? And a lot of companies have exposure because they let their employees continue working from home and they haven't taken the nexus implications into fact. So that maybe they should be collecting and remitting tax. And also, maybe they need to, we see a lot of payroll tax issues because they're still paying them as if they're working from the home office, the physical office, the business location, rather than working from home. All right, so independent sales reps, and both Tyler Pipe and Scripto, I was going to say Quill, both pen companies, but Scripto, both of these cases involved independent sales reps. But it doesn't matter really what you call someone. Manufacturers, reps, independent contractors, subcontractors, etc. This is one of the greatest areas of exposure, and it's a common nexus creating activity. Just about every state out there. Heck, there are 2 Supreme Court cases that support this. What state's not going to take advantage of that? And although the 2 cases mentioned were both about sales, that helping to establish or maintain a market is umbrella language. And some states, put out lists of what they consider to be establishing or maintaining a market. Other states do not. They just have that language. But here are some of the common things. And I'm not going to go through this list in its entirety here. And it's not an all-exclusive list either. What we tell our clients is if you're sending someone into a state and they're interacting with your clients or they're interacting with the public, that is probably going to be a good chance that is nexus creating. However, let's say you hire a bookkeeper on a 1099 basis or someone developing software on a 1099 basis. They're generally not going to be or their primary function is not to interact with the public or with your customers. They're doing internal work, and therefore those are generally not going to be nexus creating activities. So it's not all third-party activities. It's just ones that help you to establish and maintain a market. And the states stretch that pretty widely. So you got to watch yourself. And it doesn't matter what you call them. Like I said, subcontractors, independent contractors, you could just hire a company. Don't put any label on it whatsoever. And if they're performing services for you, that can be Nexus creating. So let's go to our first case study here. And this was an Amazon seller. This case is fairly old, but I like it for a couple of different reasons. They were an early adopter. They got registered everywhere that Amazon had a warehouse. And they lived in Missouri at the time. And Amazon didn't have a warehouse in Missouri at that time. So the state of Missouri was checking with the IRS for 1099s. Remember, 1090, you generally pay an independent contractor or any type of third party with a 1099. So states know this. They check with the IRS who's received a 1099 in their state. And then they go back and see who's issued the 1099 and if they're registered for any other types of taxes. And if you're not, then you get a call. But or an email or something, or you get put on a list at the very least. This gentleman got, FAM. They saw that Amazon issued a 1099. And when you cross a certain level of sales, I believe it's $20,000, they need to issue you a 1099 for the income that you made through Amazon. So and don't quote me on that $20,000. We haven't done a whole lot of Amazon work in a while since Amazon's now collecting the sales tax, but I believe that is the number. So anyway, the state reaches out to him, and he was not a client at the time. He reached out to us, and he said, "Hey, I don't have. There's no warehouse here. I don't have any thing going on. I don't have a physical presence. Everything I do in the cloud." And he asked us to make that argument. We told him, we said, we don't think this argument's going to work. He said, please make it for me. We did. The state laughed at us, said no. They said he himself, he lives here. He's creating a link with the state. So we did help him out a little bit. Not everything he sold was taxable. So we backed the state down on that. But the state had documentation that he was not registered and that he did business there for a number of years. So the reason why I like this as a case study is it really shows how states find you. It's one of the ways. And also, about working from in the cloud. The states, pretty much all of the states, no one's going to recognize that. Where you live or work, operate the company from is generally going to be Nexus creating. So travel, it's not just where your employees or contractors live, but anywhere they travel on your behalf. Now, when we talk about travel, you got things that are high on a state's radar and things that are low on a state's radar. For example, if you're sending out someone doing implementations and you're invoicing for it, well, if your customer gets audited, or if your client's customer gets audited and it shows up in the audit, and you've got something on there that says reimbursement or even an installation, state's going to find you. But what happens if you're a salesperson and you're traveling into another state? That's not showing up on an invoice. The state can still find you. Usually someone's got a tattle on you. So it's not like you could not be found, but it's much, much lower on the state's radar. This creates a problem for a lot of companies because, whoever's handling, a lot of times the accounting department is handling the taxes. They don't know where the salespeople are always traveling, or if you have independent contractors where they're traveling. So this is a potential problem area. And it's a very, very common Nexus creating activity. So let's do another case study. And this situation here was a specialized software company, and the owner of the company had a fraternity brother And when he was starting the company, and it was 30-year period, CPA said Nexus was created by traveling salespeople, so don't let your people travel and you're going to be okay. Now, they were located in the state of Oregon, and Oregon doesn't have a sales tax. So, this is an example of, don't give advice if you're not an expert in the field. This guy could have got himself in a heck of a lot of troubles because for 25 years, there were not any problems until they were contacted by the state of Washington. And the state of Washington said, we believe you have Nexus. And they claimed, this company responded, said, no, our salespeople don't travel anywhere. We don't have Nexus. And the state said, well, we audited one of your customers and you have invoices showing reimbursements for travel and you're doing installations. And installations is going to be taxable here in the state of Washington. So the state wanted and got 7 years of back tax plus penalty and interest. And by the way, the penalty in the state of Washington, one of the highest out there, 39% is what they stack penalty on top of penalty. So we got the call then, and the president of the company was hysterical. He looked at this and he said, you know what? We're going to have greater than $15 million worth of exposure all across the country because the state of Washington was nice enough to say, hey, you probably got this issue everywhere. So they thought they were going to jail for not collecting tax. And people do go to jail, but not for not collecting. It's usually for collecting and not remitting. But no one's going to jail if you did not collect. I mean, there are criminal penalties sometimes, depending on the seriousness and the circumstances, but no one's going to jail. And usually it's just going to be a civil issue. So I had to talk him down off the ledge, convince him that no one's going to jail. That was number one. And then he said, well, perhaps we should be going to jail because we're going to be bankrupt because as soon as we tell our bank about all of this, contingent liability that we have and they're going to pull all our credit lines, we're going to be out of business. So if we go to jail, we have a roof over our head and, we'll have meals and everything else. So maybe that'll be the better case. And again, I had to talk them down and let them know everything's going to be okay. There are programs out there. We can work with you. We can get this past exposure down. And they said, great. Can you talk to our bank? So I ended up talking to their bank, let the bank know that there is a path forward. There's a way out of this. And the bank said, are you positive? We said, yes. I said, okay, we're going to loan this company the money. We're into them for so much money anyway. We want this behind us. So they loaned them the money. They did, I think, 42 VDAs. And a lot of companies, are in the same position, but they don't have the money to go out and tackle 42-day VDAs. It's not the fees, it's the back tax. Because even though there's a benefit, they limit the look back period, as a reward for stepping forward voluntarily, you still either have to pay 3 to 4 years of back tax. The penalty gets waived. Very few states waive interest. There's 7 or so that waive interest. So there's still a cost outlay. So most people do this, 5 states at a time, 2 states at a time, 10 states at a time. Very rarely does a company go out and do 40 some odd states at a time. In addition to the costs, it's just a lot of work. So we helped this company. We got that over $15 million number down to just about $1 million. We did a lot of, at that time, there were some true amnesties out there. We did a lot of BDAs. We did some restructuring of invoices. So when all was said and done, they were thanking us for having to pay $1 million. I was taken back. I've never seen anyone so happy to pay $1 million. And the reason why is because they thought they were going to jail. They thought they were going to be bankrupt because they had over $15 million in liability. So this story ended up very well for us and for the client. And Ellie, let's go to the next polling question.
That should be up on everyone's screen right now. Quick question is, what about sales tax nexus concerns you the most? Nothing you have it down, economic nexus, third-party travel, and others. So why don't we give everyone a few seconds here. And quick reminder, you do have to answer these poll questions in order to receive a CPE credit. Mike, answers are still rolling in pretty quick here. Do you want to talk about this and then we can move forward?
We got a new winner here today. Very rarely do we see travel be one of the top answers. It looks like today travel is, and again, a lot of times the people who are making the decisions on where to get registered don't have all the information to do so. So I understand why travel would be up there. The second two highest answers, and these are pretty close together, are economic nexus and third parties. Those are usually the first two. Economic nexus because it's relatively new and it's constantly evolving, and third parties just because when we're thinking about our activities, it's just not obvious that we should be thinking about the activities of third parties. All right, so myth number two, it's never been a problem before, and we've been doing this, you fill in the blank, for this many years, it's not going to be a problem now. These are famous last words, just like this company we just looked at. 25 years, no problems at all until it was. It's like speeding, it's never a problem until you get pulled over. And states are getting more and more aggressive in finding companies. So just because you've been doing something one way for years and it's worked, doesn't mean it's the right way to do it. All right, so ownership of rental or rental of tangible personal property. So if you lease or rent to others, then that could be creating nexus. Remember that when you're leasing or renting, you still have an ownership interest. So if something crosses the state line, you now have a link or connection with that other state. Very common nexus creating activity. And if you have inventory or equipment in that state, you own something in that other state, usually enough to create some sort of link or connection. Let's do a quick case study on this. This is a camera leasing company. They were leasing high-grade camera equipment all over the country. It was the type of equipment you use to film movies, you use to film commercials. Massachusetts found them. They said they had nexus due to owning tangible personal property in the state. The state said, we audited one of your customers. We've seen this. The company said, we can't be doing it wrong. Everybody in our industry does it this way. Massachusetts said, well, get us a list of everyone in the industry and we'll go after them. And we got a call from one of their competitors after Massachusetts contacted them. And they said, hey, is this true? And unfortunately, we said, yes, it's true. And pretty much it's true all across the country. So again, we helped them get compliant all across the country. We helped them fight Massachusetts. Not everything they were doing was taxable, but companies telling you sometimes. And this is a perfect example of you can't follow the leader. A lot of times people will say, well, I must be doing it right, so-and-so. Someone told me the other day, well, Home Depot does it this way. Okay. Well, even big companies get it wrong sometimes, and you get a whole industry following the leader. If they're doing it wrong, and the state sometimes knows this, they focus on that whole industry and everyone gets audited. So just because a big company is doing it one way or the majority of the industry is doing it one way does not make it right. You can't follow the leader. You gotta look into this on your own. There is not safety in numbers. As a matter of fact, if the industry is doing it wrong, the amount of companies doing this works against you because they'll concentrate on an industry and you'll get found that way. All right, trade show attendance. This is an example of something that is not common. It's going to differ greatly by state. There are basically 5 thresholds for the states. One says if you attend as a consumer. Now, I think the states will be hard-pressed to make this stick. I've never seen a state do this, but they all say that they can. Participate in as an exhibitor is much more common. So if you're an exhibitor at a trade show, a lot of states out there are going to say that is going to be enough to create this link or connection. Other states say, hey, you can be an exhibitor, but you can't actively solicit. Some states say, hey, you can even actively solicit, you just can't take orders. And if you take orders, then that's Nexus creating. Nevada says you can sell and collect tax once a year without creating Nexus. So, at the end of the show, you can turn it into the promoter. The promoter is supposed to be able to submit that on your behalf. If they don't, then when you get home, you just mail the state a check. If you're not doing that more than once a year, then that's not Nexus creating. Do it twice a year, it is Nexus creating. So, people like to talk about de minimis activities, and states do not really talk about de minimis activities in most areas. When it comes to trade show, there are a number of states that do talk about de minimis activities. And the reason they do is because they want people to come to their state to go to these trade shows. So more de minimis activity spelled out here than anywhere else. Delivery in your own trucks. This is very common. It doesn't matter whether you own the truck or whether you lease it. It could be a captive company. In other words, they're only doing business with you. Relationship with someone who does not hold themselves out to the general public as a trucking company or logistics company. That could all create Nexus for you. All right, so we talked about inventory creating physical presence Nexus in most states, and this is whether it's consigned, stored, or carried by a sales representative. Some states have changed their position on whether inventory creates Nexus at an Amazon warehouse. State like Illinois and Texas, since Amazon started collecting, they've changed their position. They have Texas says if it's only used to fulfill Amazon sales, then it doesn't create Nexus. But if you're using it to fulfill your Shopify sales, then it does create Nexus. Arizona, if you ship directly to Arizona, it does create Nexus. If you ship it to another Amazon warehouse and they move it to Arizona, then that does not create Nexus. So there is some movement there since Amazon began collecting the tax, but by and large, most of the states think that it's still Nexus creating. Pennsylvania, they got their hands slapped by the court on the sales tax side. They're still being aggressive on the income tax side. Related entities, I mean, if third parties can create Nexus, how much easier is it for related entities? So if they're performing services for each other, if they're sharing assets with each other, if they have similar names and are selling common items, then those are often enough to create Nexus. Now, not all Nexus with thresholds is considered economic Nexus. Some of this is actually considered a physical presence. So click-through Nexus is where you have a company that allows other companies to put a link on their website and steers people back to their website. Prior to economic Nexus, the 21 states or so had this. New York was the first state. They said, hey, according to Tyler Pipe, if one independent contractor in a state sends you business, then how about a whole state full of people? Isn't that worse? And the highest court in New York said, yeah, it's no different. It's actually worse. So if you have a click-through program, you got to be wary of the states that still consider this to be a Nexus creating event. And the thresholds run between 5,000 and 500,000. And that's in business from one of these types of events. By the way, pay-per-click advertising, software company out there at one point was saying, oh yeah, that's click-through advertising. And they had someone getting registered in pretty much every state out there. I said, take your thumb off the scale. I mean, come on. This is crazy. I mean, each one of these laws specifically states it's got to be for specific performance. So pay-per-click advertising is generally not going to be Nexus creating. It's got to be, when we say specific performance, it's got to be a closed sale resulting from this. So use tax notice and reporting requirements. This is perhaps the most heinous thing I've ever seen a state do, and the Supreme Court let them get away with it. This started with Colorado. Colorado wanted some of the online revenue back in 2010. There was no Amazon warehouse back in 2010 in Colorado. So Colorado could not make people get registered. They couldn't force them to register, but they said, we're going to make your life so miserable, you're going to throw up your hands and say, I give up. I'll just volunteer to collect the tax. And we thought that Colorado was out of their mind at that point. Well, it spent about 7 years in the courts, eventually goes to the U.S. Supreme Court. The Supreme Court said this is not a tax and kicked it back down to the lower court, where Judge Gorsuch, he wasn't even on the Supreme Court at that point, said that Colorado was able to move forward, and DMA, Direct Marketing Association, appealed back to the Supreme Court, who refused to hear the case. And at that point, a whole bunch of states jumped on the bandwagon. And it turned out Colorado, who we thought was insane to start this, was actually one of the saner states. Some of the states, like the state of Washington and the state of Pennsylvania, they had minimum penalties of $20,000. Oklahoma is the worst of all, and they still have theirs. So the threshold is $10,000 of taxable sales, no transaction threshold, and the penalty is based on $20,000 or 20% of the prior year's revenue. So if you had $10,000 in revenue, 20% of that is $2,000. There's roughly 3 things that you need to do. It's generally 3 or 4 notices. So Oklahoma, 3 notices. The notices have to say seller's not collecting the tax, so the purchaser must pay the tax to the state. And at the end of the year, you got to turn the list of the clients over to the state. At best, that's a bad marketing message. Your customers think you're not doing their job, so you're making them do it, and you're going to tell on them. People hate being told on. So it was a bad marketing message, but it gets worse. Oklahoma, maybe you're selling a $1 item. You got 10,000 transactions times 3. That's 30,000 transactions times $2. I mean, you're way up into the 7 figures. I mean, it's ludicrous. Now, I've not seen Oklahoma ever actually do this, but it's on their books and it's still active, and they say that they're going to enforce it. So up until last year, the way the law was written for the first 5 years, the Department of Revenue could modify the penalties, but they can't after the 5th year. So this is something we advise all of our clients, even though you're not over the 100,000 threshold. If you're over the $10,000 threshold, it's something you need to take care of. All right, Ellie, let's go to the next polling question.
Yeah, absolutely. We have a little bit of a quiz. So true or false, if your sales tax mistakes have never been a problem before and you have been doing this for X amount of years, it's not going to be a problem now. True or false, and quick reminder, you do have to answer these poll questions in order to receive CPE credit. We'll leave this open. Mike, you can move forward and I'll just leave this open and let answers roll in a little bit longer.
Okay, false is the answer. This was specific to Texas, and I just want to give you a mindset of how states work. Some states considered software tangible personal property even when downloaded. And when you license software, you're generally keeping some sort of ownership interest in it. So when a customer downloads tangible personal property you have ownership in, you now have a physical presence. At least that's the argument that the state of Texas was making. This was an end run around economic nexus. It certainly was not the the spirit of the law, if the letter of the law. I didn't know how, Texas was going to try to make this stick, but they went after, this Utah company, and there was a decision and a hearing, and the Texas Comptroller Public Accounts decision hearing number 1008-626, they said, yeah, it creates Nexus. So this Utah company sued the state, and they settled. It was a closed settlement. So you'd think that the state would stop doing it, but no, since it was a closed settlement, no one knows what was done. They continuously went after companies, and if the company didn't want to take them to court, they got their money. And if they took them to court, then they settled time after time. So just give you a little bit of a mindset. People say, "Oh, I'll deal with the state. Their states were good." The IRS is a heck of a lot easier to work with than any of these states in general. All right, so here are 10 common Nexus creating activities for sales and use tax. Remember, when we say common, these are the ones that all states or the majority of the states, if not all states, look at as Nexus creating. And this is versus the 12 state-specific Nexus creating activities. And these, as we talked about trade shows, widely different on a state-by-state basis. Ellie's going to hand these out, and they're also up on our website. Worry about it, and probably a bigger issue than economic nexus at this point. Number two, economic nexus is not going away. It's here to stay. Don't procrastinate. Three, independent contractors are a major risk factor, or any type of third-party relationship. And then real or tangible personal property owned or leased in other states. It's going to be a big issue too. Ellie, let's go to the final polling question.
All right, that should be up on everyone's screen right now. It's will you be joining us for upcoming webinars? This is again a reminder that this is the first in our series of the 8-part series where we break down the pillars of a successful sales tax strategy. We'll be doing one every week until we get through them. So really hope you can join us. Watch out for those emails. There's already links available for you to sign up, and we hope to see you there. So go ahead, Mike.
Okay. How do states find you? And we touched on a couple of these already. So if you're selling on a business-to-business basis, one of the biggest ways that states find you is by auditing your customers and or your vendors. When an auditor comes out, they're not just checking to make sure that you're collecting the right amount of tax and on everything that's taxable and that all of that tax is being remitted. They're also looking at your purchases. Because just because your vendor doesn't charge you sales tax doesn't mean that it's a tax-free transaction. If it was a taxable transaction, you should have been self-assessing and remitting it to the state as a consumer use tax. So the states use that as a prospecting tool when they're looking at your purchases. If someone's not charging sales tax, the states, get a list of that. And then they have discovery units that sole purpose generally is going to be following up on these leads. They do have other activities, but their sole purpose is to find taxpayers who they believe should be paying tax to the state and are not currently doing so. We talked about information sharing, and it's not just with the IRS. It's the other government agencies. Customs and Border Patrol is another one we've seen. Information sharing with other states, the Southeast and the Midwest. There's groups of states that share information, leads. Some of the states pay bounties to people who turn companies in. So you have a former employee who thought that you should have been collecting sales tax, and they're disgruntled. They can turn you in. Not only do they get their pound of flesh, they could get paid to do it. Competitors, we're hearing this more and more because people are hearing the footsteps. They want to get registered for economic nexus, but on big ticket items, they're afraid that if their competitors are not charging the tax, then the dollar amounts in question are enough that they may end up losing more sales than it's worth it. So we get the question, is there some way to turn my competitors in? And unfortunately, there is. Customers, you don't charge someone sales tax. They call the state and say, hey, my vendor didn't charge me sales tax. Do I need to pay use tax? And the state says, well, who's your vendor? Next thing you know, you're on a list. And then the states purchase lead lists. Web surfing, some states are notorious for this. And sometimes you have individual auditors out there on the internet. Other times you have specialized software called web crawlers. State of Washington is notorious for this. Personal experience. Auditors shop, they watch TV, they listen to radio, articles in print or on the internet. I mean, salespeople and other employees here bringing me things all the time. I sit there and watch TV. I laugh. Sales tax only charged in these 3 states or these 6 states. Well, why? I mean, you're selling nationwide, and this is a national broadcast. It doesn't take a rocket scientist to figure out you should be collecting sales tax everywhere. Stakeouts. There's a huge trade show not trade show, but flea market. I mean, it's huge, supposedly the largest in the country. They call it First Mondays here. And the Texas Comptroller Department will send teams out there to roam and make sure that everyone's collecting sales tax, industry listings, other types of registrations. You're registered for one type of tax and not registered for another. This is one of the ways, easy ways for a state to find you. Okay, who's listed for a payroll tax in our state? Okay. Are they registered for sales tax? No. Put them on a list. And just because you're on a list doesn't mean you're getting called that day or that week or even that year, but you're on a list, and eventually these discovery units will get around to you because the states are always looking for new taxpayers. They always have a constant need for revenue and always looking for new taxpayers, especially if there's a recession out there. And whether we're officially in a recession or not, tax collections, whether it be sales tax, income tax, are down in a number of the states out there. So we really see a perfect storm. We think the states are really going to be stepping up their activities. That's one of the reasons that we've created a new product out there. It's prepaid audit coverage. So for a single fee, we'll defend you in any audit between now and the end of 2025. So if you have an interest in that, reach out. Ellie will get you connected with one of our people. But I think, Nexus is more important now than ever. It's really a perfect storm because the states know people are not compliant for economic nexus, and they're going to be looking for companies not compliant for economic nexus. And while they're doing so, they're going to stumble across all types of companies. And, having economic nexus for 6 years is bad enough. What happens if you had an independent contractor for 10, 12, 15 years? Most states are going to limit themselves to a 7 to 10 year look back period. But even in the states, I've seen Texas try to go back 12 years, even though they say they go back 7. And Ellie, at this point, why don't we open this up to questions?
Yeah, absolutely. We don't have any questions at this time. Is there anything you want to address in the last couple of minutes here?
No, we covered everything pretty thoroughly, I think. If you do have any questions, then just get them on over to Ellie and we'll try to get them answered for you. Some questions are very easy to give you a quick answer to. Sometimes you do not want a quick answer. It's more something that needs to be researched. But there are a lot of questions that we can answer right off the tops of our heads. So we appreciate you joining us today. We hope that you'll join us for the rest of this series. It's a great series, in my opinion. And again, I put it together, so I'm going to be a little bit biased there. But if you take care of these pillars of a successful sales tax strategy, when you do get audited, because because you can't prevent audits. It's, you know, sometimes it's just a lottery. But you can definitely limit the red flags that could cause an audit. And if you're doing this correctly, you'll take care of a lot of the issues so that if you do get audited or when you do get audited, your exposure will be minimal. So thank you again for joining us, and we hope to see you on the next webinar. Bye-bye.